It's not just a drawdown that we're looking at. We're looking at many years of probably a negative stock market environment.
Thanks for joining us for part 2 of our interview with money manager Eric Hickman. If you haven't yet watched part 1 of our discussion with Eric, in which he presents his argument that the stock market is at risk of falling in half soon, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment perspective that Eric and our partners at New Harbor Financial share in this video. Oh, and if you haven't yet, don't forget to subscribe to this channel by clicking on the red subscribe button below. Okay, here's part 2 of our interview with money manager Eric Hickman. You said that, what people need to realize is, there's a lot of self-inflicted damage that happens at a market turn because the bulletproof rules that got us to the market's apex stop working on the way down, and yet it takes people a while to kind of get the memo. So, right now, one of the most defining trends of the past 10 years has been the buy the dip movement, right? Fed's got your back, market goes down, buy. You're getting it on sale because, it's going to get goosed higher. And it sounds like what you're saying is markets are going to go down, those people are going to jump in, anticipating that sharp, upward recovery. And it's not going to happen. And then they're going to keep doubling down, expecting to get saved. And it's just,
And that's how you lose.
White knight's not going to arrive.
Yeah, no. And that's how you lose more than what the drawdown is. Let's say it's 50%, but I think it's pretty easy to make that 80% for yourself because you've continued to believe in the market. There's a saying that I have written in the piece that a bull market does everything it can to keep you out. A bear market does everything it can to keep you in. And I think that describes that philosophy or that psychology. After you've experienced 12 years of a bull market, the dip will be something that you think you're doing right. And if it's a true bear market, it's not right.
So, you just mentioned 50 plus, corrections. So I'm not sure how much this question applies, but how bad could it get after a populace that's been trained basically, for the past 12 years that don't worry, doesn't matter what the market does, the Fed's going to step in and rescue you. And, we now have a generation of investors that pretty much only know a guarantee that the market's going to be higher at the end of the year than it was at the start.
Yeah, something that I noticed in in 2009, I was expecting to see PEs in the single digits. We only got down to 12, probably because we had the Obama stimulus at that time and the advent of QE. But somehow, the market is going to be a single digit PE, and probably for a while. That's kind of the point of my piece. It's not just a drawdown that we're looking at. We're looking at many years of probably a negative stock market environment.
Yeah, and that's really important. So we talk a lot in this program about those analysts who do project a negative return over the next decade in the markets. John Hussman is one we mention often. We share a lot of his charts. I think that's really important because if you're watching this video and you are anywhere from your mid 40s or older, that's a good chunk, if not all, of the rest of your active career where you're earning money and trying to save towards your retirement, and to do that in the headwinds of a market that is losing value year after year after year. And of course, it's not going to be uniform, right? There'll be some years that'll big downs and some that'll be up. But that's a daunting prospect, isn't it?
It is. And there's a lot of things that we're familiar with that have been built up because of it. Like, for instance, the CNBC is popular because of stocks going up. If stocks come down and the stock market is not exciting, I don't know what a CNBC does.
It talks about, nobody wants to tune in to see how much money they lost, right?
And that's just one example. I mean, there's so much financial media that's based upon that positive outlook about stocks.
All right. Well, let's try to inject some positivity of our own into the outlook. For people who are watching, which Eric, mostly are people that they're just concerned investors. They just don't want to become roadkill if there is the type of correction that we're talking about that happens here. So they want to protect their wealth from the risks we're talking about, and ideally want to prudently grow it if they can without taking on too much risk. What would you advise those people? I mean, I know that your firm is pretty heavily invested at this moment in long-dated treasuries, correct?
That's right. We really have specialized in treasuries for our entire history, our 30+ year history. Treasuries are the only thing, barring maybe German bunds and JGBs, Japanese government bonds, that reliably appreciates in a negative environment like we're talking about. Gold kind of does, but not always. So for instance, gold came down with all the commodities in late 2008. So a long-term treasury at the 30 years at 225, it offers a pretty juicy yield. I mean, it doesn't sound juicy, but juicy versus where the rest of the world is. I think the average 10-year yield of developed economy bonds is about 60 basis points, where ours is way over 1%. So there is a gap there to, when rates fall, to experience appreciation in bonds, in treasury bonds specifically.
Yeah. So a question on that, which is, given how low rates are versus the rest of history, right?
Yeah.
How far really can these bonds fall? Can the U.S. Treasury go negative?
Yes, I think so. I think the Fed is very loath to bring short-term rates negative, because that blows up the entire money market industry, and kind of the banking industry too. So they don't want to do that, but there's nothing to say that long-term treasuries can't come down to zero. And if enough bad things are happening, we've learned from all these other countries that negative is not, it's not impossible. It's the German 10-year is at minus 30 today.
Yeah, and let's just play it out for a second for folks that are watching that don't understand bonds super well. As interest rates go down, the price of the bond goes up. Yeah.
Yeah.
And that's basically because people are bidding to get into the safety, right? So in the case of the treasury bond, long-term dated treasury bonds going negative, Eric, I'm going to put words in your mouth, so you correct me if I'm wrong here, but you would say if you're owning it for defensive purposes, you wouldn't worry about getting a negative return on the bond, because you're making way more money on the appreciation of the bond price.
Yeah, no, that's right. It's a good distinction. The yield on the treasury is not very interesting to us. The only thing we really care about is where we think it's going from X to Y. Yes, you do get paid the yield as you wait, but the real money or the real opportunity is in changes in interest rates. And that's what we're expecting.
Okay, so just sort of recapping your answer to this question about any advice to concerned investors watching this, it sounds like you would say be defensive, and one way in which your firm has chosen to be defensive is to park into long-dated U.S. Treasury bonds with the expectation that rates are going to come down when the wheels start coming off.
Yeah, and there's a real reliability in that happening. Whenever we have stock market problems, rates fall, or at least in the last 30 years, that's the case. Because when economics are bad, people want safety and they go into treasury bonds, so they're bid and rates fall.
Okay, and do you have any concerns about rising inflation maybe potentially forcing the Fed's hand here and them actually having to raise rates?
Well, it's interesting you asked that. Janet Yellen was caught saying something to that effect yesterday, and then backed it out today. This period with inflation reminds me a lot of June 2008, which was in the middle of that recession. Oil went up to 145. All the talk was about inflation because the Fed had lowered from 5.25 to 2, and that was considered to be so huge of an amount of stimulus that there must be inflation. And that's really the conversation that we're having today. There's so much stimulus that there must be inflation. We haven't actually seen it. Well, we see it in commodities, but commodities can turn on a dime. So that can really all be speculation, or in this case with the pandemic, just imbalances in different marketplaces. So no, I think that this inflation, we will see the peak of it in May of this year, which will be released in mid-June. Headline will be somewhere in the 3% range, I think, maybe up to 4%, which is about what we saw in June 2008 as well. But I think that that's it. I think if there is a stock market drawdown, that will take all the inflation away real fast. So for all, and we've been through enough of these inflation scares that this looks like another one.
All right. Well, look, as we wrap up here, first, I want to say, Eric, when I reached out to you, you had told me that this was sort of one of the first on-camera interviews that you had done, and you had some understandable jitters about that, but you've been a pro. You've been great. So thanks for coming on. You should do this more often.
Oh, very nice of you.
Well, my pleasure. Well, look, for folks that have really enjoyed hearing your insights here and would like to learn more about you and your work, where can they go?
A good place to start is Twitter. Eric W. Hickman is my Twitter handle. You can also find us at KesslerCompanies.com. Either way.
Great. All right. When we edit this, I will put up the URLs for both of those on the screen there. Well, Eric, look, thank you so much. It's really been a pleasure. And I hope if the market does have some sort of correction in the way that you've been predicting here, that you'll come back on and help us make sense of it as it's going on.
I would love to.
All right. Well, thanks so much for coming on the program, Eric. It's a real pleasure.
You bet. See you.
All right. And as we do every week, I'm going to do a little bit of post-game recap here with the lead partners of New Harbor Financial, the financial advisory firm endorsed by Wealthion. Mike, why don't we start with you? Just love to hear your general reaction to what Eric said.
Really enjoyed that talk by Eric. Thanks, Adam. It's good guest, and not just because his viewpoints agree with a lot of ours, but because I think that his viewpoints agree with the data. You know, at New Harbor, we look at the data quite diligently, and we see a lot of the same things that Eric was talking about. He used some words there. He said that the public and the investing public is lulled into complacency. I can tell you that we have seen that in spades over the last few months. More and more people want to get in. There's some fear of missing out. Certainly is a pretty prevalent emotion. And even just looking at the tape, the market on a day-to-day basis, we hardly have a down day, never mind a down week, or even a down hour. The market, the bounce in the market is just breathtaking. I mean, there's just this buy the dip feeling to it that's just relentless at this point. Some other things he said too, in that interest rates have been a tailwind for this market for a long time, and that's probably ending. We're probably at least in the area of that ending. Although he did say that they've got a position in long-term bonds, which we also have for a trade at New Harbor. We're very heavy in cash, close to 50 to 60%, but a portion of that is in long-term bonds for a trade, because we think as low as interest rates are, there's a chance that there's going to be a flight into the longer term bonds. We're seeing a little bit of a bounce actually today. And, the speculative fever, this unprecedented surety that Eric talked about, because of the SPACs and the NFTs, and the retail participation, people are just all in here, and the kind of Robinhood crowd and the Reddit crowd, the speculation, the euphoria, the distance from the 200-day moving average that the S&P is at here. I mean, we're just seeing signal after signal after signal that tells us this is an extreme market. It's getting redundant to say it, but we're going to keep doing the same thing, being conservative, waiting for our opportunity. We've got some hedge positions on, and we would just caution people about this. It's hard to keep saying it every week, but caution people about this market, reduce your exposure to stocks, try to get down to 30% or less. That's our general advice.
All right. And yeah, I kind of thought you guys were going to enjoy Eric's commentary there for a variety of reasons, but one, because he gave, I think, a few additional data points to look at that corroborate the many that we've been talking on this program over the past bunch of weeks. John, I want to come to you to build on something that Mike was commenting on there. And this was the discussion that Eric and I had about how at the end of one of these good periods on his chart, that everybody is in stocks. Everybody is all in. Stocks are seen as the answer to everything. And then, of course, you get, whatever it is, your greatest fool, the last person to buy into the stock market, and then it all begins to collapse. And, as you enter the bad period, what Eric said, which I think is really interesting, and where I think a financial advisor like you guys, really earns your work there, is where, the rules that work so well during the good period stop working, but it takes the investing public a long series of painful losses before they kind of get the memo, right? So, I think in this incarnation, it's the buy the dip mantra, right? I mean, there's just so many people that have been so programmed and so rewarded for buying the dips, and frankly, punished for not buying the dips, that when this market reverses, you're going to see tons of losses as they first double, then triple, then quadruple, then quintuple down, waiting for that expected recovery that's not going to emerge. And, Eric said that's where a ton of wealth gets lost when you have these market transitions. Thoughts?
Yeah, no, that's so it's the piling into of equities by all manner of investors is just this sign of sentiment and psychology. We like to joke about magazine cover sentiment. If you look at kind of popular magazines, be it Time magazine or Newsweek or whatever, some of the sentiment that those magazine covers start to publish, certainly at major market turning points or extremes, maybe they'll feel like that at the time. They actually end up being quite contrary indicators, like this person was man of the year or woman of the year at a time when their stock was on fire, but then it was almost to the day, kind of the top of the stock and vice versa. So it's just really a measure of sentiment. And yeah, that sentiment is psychologically driven. So when a top does happen and starts to reverse, it's usually many weeks, months, even years before the psychology fully takes hold in the reverse. And it usually is at the wrong time, because folks that maybe are in at the top or waited to buy in near the top, that hope that led them in is not easy to shake. And in fact, it quickly turns to regret. For example, if they quickly start to see losses, that regret comes in the form of bargaining that takes the form of something like, well, geez, that's just a pullback. I'm just going to hold tight and I'll sell if I get back to where I bought at, right? So there's this mental bargaining, and guess what? Oftentimes they don't get that chance because by definition we were at the top, looking hindsight, and then they're down 20% instead of 10%, and then they say, well, I really can't sell now because I'll just lock in a big loss. I'll wait till I get back to 10% down and I'll call it a day. And what happens is that sentiment shifts and the trend shifts, and they end up riding it down 20, 30, 40, 50%. And it's only at that point where the despair kicks in and says, you know what, I need to get out at any price. This is going down another 30%. And that's the insidious nature of psychologically driven sentiment that we see at major market extremes, which is classically, everybody's in the boat at major market tops.
A great summary, and this is just again why we at Wealthion are so we recommend so strongly that people work with professional financial advisors, because we're humans, we're animals. we think we're rational, but we really tend to be rationalizing. And we tend to make emotionally driven decisions even around money. It's very scientifically proven. And so working with a professional who can take the emotion out of the decision making and help guide you to making just sort of trigger-based, empirically based decisions, super, super useful. All right, so Mike, I want to come back to you to talk about or get your thoughts on when Eric and I were talking about potential triggers for what might finally, cause this reversal. He quoted Grantham, Jeremy Grantham, which is somebody we've talked a fair amount about in this program in the past. But he brought up that piece that Grantham wrote in January, where he basically said that he was predicting that we may begin to see the next really big market downturn in late spring, early summer, which was his estimate back then of when the COVID vaccine rollout will have been predominantly deployed. And at that point, Grantham predicted that folks would pick their heads up and say, okay, we've sort of averted the major crisis we've been battling for the past year plus. And now that we're looking around, we're realizing that we have an economy that's still not all that strong, and yet we have these ridiculously overvalued asset prices now, and that might actually be the trigger. Now, Grantham seems to have been pretty accurate in predicting the timing of the vaccine rollout. I think he did write his thing before the latest trillions in stimulus packages. But do you see that as still kind of a high probability trigger? And do you think his timing of late spring, early summer still holds water here?
I think that makes sense, Adam, but I think we've stopped trying a long time ago to time it. You know what I mean? Because we really don't know. I think he also said it could be this, talking about Eric now, he said it could be this year, could be next year. Who really knows? I mean, the biggest tops in history really haven't had a catalyst or a trigger. For based on my reading, 1929 didn't have a trigger to start the Great Depression and drop 89%. October 19th, 1987 didn't really have a trigger. I mean, it was blamed later on portfolio insurance. And in 1987, the market was far more fairly valued than it is now. I don't think we necessarily need a trigger. I think that sometimes it's just because all the good news is out. And that's what I guess Jeremy is saying. Jeremy Grantham is saying is that, the economy rebounds, employment gets better, the vaccines are rolled out, the COVID crisis seems to be behind us. And all of a sudden, everyone owns stocks. I mean, the participation or the percentage of households' financial assets that's owned in stocks is at an all-time high. If everyone's in, who's going to buy next? That's the problem. And so you mentioned that Jeremy's piece might have come out before the 1.9 trillion in stimulus. That's true, but honestly, that might even make it more ominous, because yet more stuff has come out that's bullish, post that piece. And so what's next? We have a situation where we've never seen higher valuations. We've never seen, for the most part, almost never seen such stretch technicals versus the 200-day moving average. Again, household participation at an all-time high. It's dangerous. It's really, really dangerous. And yeah, I think his time frame makes a heck of a lot of sense. It can't go on forever. I know that. And this is it certainly has the right feel for it to be this year.
All right. So well said. It sounds like you're saying, look, it could happen at any moment, but that moment could be a minute away or a year away. Who knows? But it feels like it is more likely to happen sooner than later. And this comes back to the old adage that when it comes to positioning for a market reversal, it is way better to be a year early than it is to be a day late, right?
Yeah, but being early is painful. It is. But there's no way not to be early in a market like this. You're going to be early or you're going to be late. Yeah.
And early being prudent and defensive. If you're early and aggressively short, which we've known some people over the past couple of years who have tried to aggressively short this market, it can be deadly if you're too early. All right, so which again underscores your guys' strategy of always, whatever position you're taking, using hedging and risk management techniques just in case the trade goes against you. All right, John, coming back over to you. What do you guys think about Eric's firm's position of playing these next couple of years by being long-term U.S. Treasuries? Haven't heard too many people arguing for that.
Yeah, no, for some, as Mike already pointed out, we do have some exposure to that right now. It's anytime Eric or any of us asset managers talk about positions, we need to be careful not to, like project that this is all the eggs in one basket kind of thing. For a portion of a portfolio, that can be a very proper thing, even though their yields are still very, very low, and a traditional bond investor, might, kind of squirm at those yields. For a piece of the portfolio, especially in a kind of deflationary bust scenario, that could be a very good play, right? And that will play out over time, and hopefully, we don't ever, or rarely do we look at positions kind of in a long-term kind of static hold kind of way. We always let the data kind of guide us, and certainly there's some data and scenarios like what led us into some long-term treasuries for our clients right now that suggest that's a good position. But I wouldn't certainly be 100% in long-term treasuries, nor is Eric. And so a piece of the pie, sure. I think that's because we're still kind of fighting this inflation deflation battle, though there's been plenty of evidence of real, not just imaginary, but real inflation starting to take hold. Warren Buffett in the annual Berkshire Hathaway, kind of communication last weekend, the meeting, talked about very significant and real price pressures in their portfolio companies, in their input prices, real serious, signals there. We're seeing commodity futures off the charts. Lumber, steel just hit a new all-time high. These are really convincing signs of inflation. And you're starting to see even Federal Reserve speakers and surrogates start to jawbone about, Janet Yellen, for example, came out earlier this week saying, I think interest rates will have to rise at some point pretty soon. And then, market didn't like that. She walked that back really quickly, said, I'm not projecting anything. I think today the Dallas Fed chair talked about, kind of needing to taper, stimulus and easing on interest rates sooner than maybe the market consensus, and that gave a little spook. But there's like this dancing around this, really sharp line of, inflationary, deflationary type things that, it's has all markings of policy being backed in the corner and not a whole lot of good choices.
All right, well, let's use that point about inflation as a segue into the last question here, which I'll come back to you with on, Mike. We had Warren Buffett come out last weekend and, as John said, say, hey, look, I don't care if the Fed says we don't have much inflation and whatever we have is going to be transitory. We're seeing it explode everywhere. Famous investor Sam Zell, who is 79 years old, says, I self-admittedly said, I've kind of been a skeptic of gold my whole career, and I'm now buying it for the first time. So when you get a guy who's, been that successful an investor, who's been sort of famously gold, negative, saying, hey, I've finally seen the light, I'm buying in. I look at the gold price, it's up actually a fair amount today, silver up even more, but it gold's back above 1800. It looks like the precious metals may have indeed bottomed there in end of March, and a lot of people own precious metals as defense against inflation, specifically monetary inflation. What are you guys seeing when you're looking at the precious metals right now?
Yeah, I mean, we certainly see the inflation that you're talking about. All the grains are taking off, as I think maybe John mentioned, lumber and a lot of other base metals. Everything's taken off, Bitcoin, cryptos, except for precious metals. It's been kind of maddening for precious metals owners that, precious metals topped in August of 2020. And we were looking at that area down in gold at 1680 to 1720 for quite a while. It did go into that area, I guess, a month or so ago, and it's been moving sideways, slightly up, and then boom. Finally, we're seeing some catch up today. Gold up 30, silver up $1. Gold mining shares up pretty sharply. So yeah, it looks like they're starting to catch up, which is a very encouraging sign. It's nice to hear, that Sam Zell was saying that as well. It's almost unbelievable to think the whole commodity sector would be taking off and gold and silver wouldn't. I know there's a lot of thoughts about outside forces on the metals market. Even if there were, that can't last forever. So, we're starting to see we're starting to see and think now that gold and silver are poised to make this move higher, and they're starting to do it now. If you take a look at the miners index, which I'm looking at right now, or GDX as a proxy, it's back up near 37, getting closer to 40. So yeah, stealthily, they're starting to move and break out. And interestingly, not many people are talking about them yet,
Yeah. So
which is always a good sign.
does this seem like a good time for folks that maybe missed the earlier miner run up this year, or were afraid to get in as it was cooling off? Does this seem sort of like a promising time to maybe start thinking about putting some additional money to play in the miner space?
I think so. Yeah. I mean, again, looking at what commodities in general are doing, and the fact that the mining companies are undervalued on a fundamental basis. And there's been a lot of cleaning up of balance sheets in the last 6, 8, 10 years in that space. And they're just insanely profitable at, gold at $1,900 an ounce, $2,000 an ounce. If you look at a chart of gold, it projects up into the, 2,000 to 2,500 range. If you look at this long-term kind of weekly or monthly chart triangle. So, I mean, if it goes there, these mining shares should behave very well. I mean, from a technical standpoint, we've seen GDX pull back to 30 or so after its high at 45. If it is basing out and it's going to break through that old high, it would go up into the mid 50s, maybe this year. So yeah, if you don't own it already, all the fundamentals say buy it, the technicals say buy. As John said earlier, it always has to be right for your portfolio with the right position size. But we can't think of a better sector here that we would want to own. Maybe oil stocks that we also own, but they're underappreciated. They're not being talked about. The technicals are looking good. Yeah, it would be a good place to add them.
All right, great. All right, guys. Well, with that, we should probably just take a quick second and talk about the June 5th conference, online conference that Wealthion's putting on. We have a great lineup for that, folks, if you haven't heard of it yet. And Mike and John are actually going to be my co-hosts for it. So you'll get to see the three of us kind of play the role of MC as we go through that day. But we are going to have, if you're interested in what's going to happen on the inflation side of the story, we're going to have noted inflation, deflation expert Lacey Hunt kick things off. We're going to have Grant Williams and Stephanie Pomboy, who will share their macro views as well. Having them together is just a total coup. We're going to have David Hunter, who has very correctly and boldly predicted the melt up in the S&P that we've been watching over the 2021 so far. He thinks it still has further to run. Of course, he then predicts a massive correction after that, somewhere between a 65 to 80% collapse in prices. So we'll get an update from him as to whether he still thinks that's the case, and if so, what timing he's looking at. We'll have Lynn Alden there to talk about cryptocurrencies and her thoughts on the future of the US dollar. Let's see, we're going to have Mike Maloney to talk about precious metals. We're going to have Matt Taibbi to talk about media control, and specifically the key stories and voices that we are not hearing enough from at this point in time because they are being silenced. And then we're going to have other presenters there, as well as some other key asset classes like farmland, real estate investing, and a few others. So it's going to be great. If you can, go to wealthion.com/conference if you want to register, and it only takes you about 15 seconds or less to do so. All right, guys, in our last minute here, folks, if you haven't yet, please subscribe to this channel. Can't say that enough. It really helps how these videos get distributed across YouTube. Make sure you don't miss any of them. If you want to see who we're going to have on the program in the future, and we've got some great additional guests lined up in the next couple of weeks, follow me on Twitter at @MenloBear. And then lastly, just want to reiterate for those folks that don't know, Wealthion, if you're watching this video and you'd like to talk to a financial advisor who, takes into consideration the risks that Eric and I talked about, the folks here at New Harbor Financial, John and Mike and their team there, they offer free portfolio consultation reviews to anybody who's watching this channel. And they do that because they just want to make sure that they can help as many people position in advance for what may be coming as possible. So if you're interested in talking to them about that, just stick around at the end of the video. It takes literally like 5 seconds to get on their radar and request a meeting. And with that, John and Mike, thanks for yet another great week. And no matter what happens next in these markets, we'll be tracking it together here. And I'll see you on this channel next week.
Thank you, Adam. See you next week.
Thanks, Adam. See you again next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.